In other words, the only way those strategies work is there is an opportunity cost with everything you do. So how much is it costing me to, let's say, leverage that money versus how much do I have to actually be able to offset it? There is a line like this, right? It's not a net sum scenario. So how are you calculating that barometer? So going back to paying extra money to principal again. Of course, paying additional money to principal is going to pay a given debt off. But because the average person doesn't have an unlimited amount of income, they also better make sure that they're deploying it or redirecting it in the most efficient manner possible. If you had an extra $100,000 a month in discretionary income, okay, well, I guess maybe it doesn't make a lot of difference. But if the average person has an extra 100 or 500 or even 1,000, that 1,000 can't be spent 10 times. So if you spend 999 of it on one debt, maybe that was a good decision. Maybe it wasn't. But you only have one option there. So it's a matter of how do you know it shouldn't have been $327.11 to this debt on the 14th? How do you know it shouldn't have been $286.96 on this date to another debt? You don't. So I'll give an example. Biweekly payments. I've talked a lot about this. Do I think that that's a strategy that works? Well, of course it is to an extent. Why? Because there's 52 weeks in a year. Half that is 26. Half that is 13. So you are, in fact, creating additional principal payment here. Well, CJ, it doesn't take a lot of creativity to realize if you make one additional principal payment a year directly to principal, that is going to lower your balance faster. No magic there. However, I will say it doesn't work the way most people actually in their mind thinks it works. Because they're thinking that when I pay the money to it every 2 weeks, it's getting to principal 2 weeks sooner. And that's not true. There were some companies years ago that had 14-day amortization. That's been all but done away with. Because why would the bank possibly want you to have the benefit of applying your money faster?
Right.
Because a note says, a mortgage note states, with very few exceptions, but in 99.9% of scenarios, that whether you pay half the balance every 2 weeks or a quarter of the balance once a week, you could pay 1/30th of the balance every day, in theory. Yet none of that money is actually going to get applied to principal faster until the entire minimum monthly required payment is satisfied. So what that means is technically, although you are doing what we just discussed, who's benefiting from the leverage of that money for that 2 weeks? Because it ain't you.
Nope.
Just like escrows, just like a tax refund, just like getting paid once a month from your employer instead of once a week or whatever the case is. So it's not a bad thing. Of course, creating extra principal payment is good. I'm simply just saying it doesn't work the way most people think it works. Now let's go to people that pay extra money to principal. Of course, that's a good thing. Of course, paying more money to principal is a positive thing. But then the question is, again, most people do not have an unlimited amount of income and therefore an unlimited amount of discretionary income. So the question is, little bits make a difference. How much are you deploying and to which debt? How frequently, when, how, and where, right? So how do we do it strategically? The other thing is, let's say it's just your mortgage, CJ. And let's say you send an extra, I don't know, $200 a month. Okay. Wonderful. That is going to go to principal. You are going to pay it off sooner. Congratulations to you. However, if that was your only strategy, my next question would be to you, is there ever a scenario where something comes up in life that you're not able to send in that $200? Of course, probably, right? Oh, I didn't realize that I had to buy 4 new tires. I mean, life is going to happen. But then my answer to you, well, in that month that you didn't send the 200, did you send $86.12 instead? Or did you send zero? The answer is you probably sent zero. And by the way, does 1 month ever lead to 2 or 3 months? Yep. How many kids say, I'm going to take a year off of college so I can, see the world? And how many of those people ever make it back? Right? This is just life. This is just understanding life here. Okay. So our focus is, it's not that there aren't certain things. Having a 15-year loan would have you scheduled to pay off 15 years sooner. Excellent. Paying biweekly, great. Extra year, extra payment to principal. More money to principal, yes. Those are all ideas that do have a benefit. Certainly not denying that. But are they able to maximize the benefit consistently, efficiently, effectively, and sustainably over time? Because those little micro dollars, I'll call them, 10, 20, 50, 100, $200 here and there, they're not a small part of the process. They're the game changer. And knowing exactly how much to pay when, to which debt, in which manner is everything. So it's all about consistency. It is all about follow through. It is all about execution. And lastly, it's all about actually visually seeing the impact of what we're doing. We've talked about this, right? In the 6 marathons I've run, I can tell you for a fact, there's a reason there's a mile marker every mile for 26 miles. And they've done studies where they removed all the mile markers and didn't let anybody have a GPS watch. And the times were significantly lower. And the number of people that dropped out of the race was much higher. Why? The distance wasn't less or more. It's because psychologically, I went 6.5 miles. I'm a quarter of the way there. I'm at 13.1. I'm halfway there. I'm at mile 20. I'm at the wall. There's all these things because that's what people have lost financially. And I hate to say this, I am going to vilify the financial institutions here for a second. They want it that way. They want us to not know where we are. I'm sorry to say. Again, I'm not vilifying the banks, but in this one area, I'm going to. They love ignorance. They love confusion. They count on it and they exploit it. That's why they have you focused on payment, not cost. Remember, price is a one-time thing. Cost is a lifelong thing. So that's why subscriptions are so popular now. Why do you think you don't get to pay one cell phone bill and be covered for the rest of your life? Or one internet bill, or one cable bill, or one anything? Because it's death of 1,000 cuts. It's only $19 a month. It's only $39 a month. It's only $99 a month. And we become completely paralyzed and overcome by the death of 1,000 cuts. So being able to have all this in one snapshot is an absolute total game changer. So there's a lot of things that work. I applaud those that are doing some of those things. I do. But if you're doing those things, you're doing them because you're looking for an edge. Why don't we take that edge and supercharge it and put it on steroids? And that's why I say it's not just about velocity banking or even infinite banking. It's about automated velocity banking. It's about accelerated velocity banking and infinite banking. It's how do we take that strategy, put it on steroids, create more structure, more accountability, a greater impact. Because once you see the finish line, so to speak, when you're running a marathon and you know that it's up there, how many people do you think pick up the pace? Everybody.
Right.
I can see it now. And you know what happens when you start seeing your debt-free date isn't 25 or 30 years off into the future? You can see it's 3 years or 5 or 7. You pick up speed. You look for little ways to gain an edge. And that is the game changer. And that's why our whole focus is to honestly help people take back America one family at a time, one budget at a time, because nobody's coming to save us. I hate to break this to everybody. Nobody's coming to save you, right? Charity begins at home. And we got to start taking better responsibility. And that's our whole company's goal, right? I'm sure the financial institutions hate us for it, but our whole goal is how do we turn the tables and let the average person effectively bank like a bank with the same kind of technology, the same kind of foresight, and be able to achieve many of the very same results.
So when you're talking about lines and loans, these are things that have buried people, right? They have buried people. They have caused people to go without hope. And I know it's not totally their fault, right? But when you're talking about lines and loans, could it be because we're using the line of credit that we're using the loans for an incorrect purpose? We only use it to consume and not invest. In other words, what are lines of credit and loans? What are they supposed to be or recommended, or what is the best use for the lines and the loans?
Well, let's start with what doesn't work, right? There's a lot of things that work or could work, and that's subjective, all right? But what we do know is this, and I know, man, this is going to hit a lot of people sideways. So I try to pick my words, but sometimes there's no other way to say it than the way to say it, okay? 2 concepts I love. Love velocity banking, love infinite banking. There's about 10 others I could give you, but just for the purpose of this conversation. Mathematically, systematically, ideologically, from a concept standpoint, a theory, a strategy, love it. You know what else I love? I love exercise. I love eating right. But again, if you go to a seminar and somebody tells you what to do, great. You're going to remember that for about 5 minutes until you walk out that door. If you read something, watch something, same thing. I'll give you even a better example, right? I live in South Florida. Let's say I don't know, verbally told you where I live. Maybe you'll remember how to get there, maybe you won't. Then I tell you to write it down. Well, maybe you'll read your own writing, maybe you won't. But even at that, what's going to keep you on track to get there at a certain time? I'm taking my daughter up to Orlando on Thursday. Okay. I know it's about 3 hours away from me, give or take. But if I just spitballed it and just what happens when there's a car accident? Oh, and there will be because the highway is the worst up here. And there's a sudden sun shower that comes out of nowhere, which is typical in South Florida, or any number of other things. Or my daughter has to stop and go to the bathroom for the third time, or we have to get gas or food. That's life. Okay. The biggest problem is this. Man, I know I shouldn't say this. I love these concepts, but I love people to be successful more. Again, road to hell is paved with good intentions. If you had a $500 credit card, and I'm asking this of everybody watching, okay? Let's say you had a $500 credit card, or a $5,000 credit card, or a $50,000 credit card, or a $500,000 line of credit. Does the amount determine whether or not you're going to have a balance or not? No.
No.
You just have more access to make bigger mistakes. It doesn't mean you will. I'm simply stating the obvious here, is that they don't have numbers that show us that somebody that has a $5,000 credit card limit versus a 500 increases or decreases the likelihood they're going to have a balance. The reason we have a balance is because expenses change daily and income changes all the time. Well, this factor right here does not change predicated on how much access to credit you have. You just have a bigger hole you can dig yourselves into unless you are committed to deploying an actual systematic strategy to follow through. Because let's say, as an example, in the line of credit scenario, yes, are these typical simple interest calculations? Yes. Are they typically lower interest rates? Yes. Are they often even tax deductible if it's a HELOC or et cetera? Yes. Consult your tax advisor. Okay, but the whole point is yes. But here's the reality. Guys, the road to hell is paved with good intentions. Yes, you could leverage that money to pull out equity and do a renovation. Great.
Mm-hmm.
You could consolidate stuff.
That's right.
But what happens the minute we reduce the pain? We become more apathetic, not less. And now all of a sudden we're like, oh, I'm good. Problem solved. You know how many loans I did where I restructured all of somebody's debt? And I mean, I'm thinking like a mortgage planner here. We're going to restructure. You got 6 debts. Now you got 1. We've lowered the weighted or the blended interest rate. You got a larger deduction. I've solved all your problems. Do you think any of those people end up getting back in debt? Most of them end up getting back in debt. And then they come back knocking on my door 2 or 3 years later saying, hey, I'm in trouble again. Bail me out. And then they treat their home like an ATM.
Mm.
So again, mathematically, I can advocate that lots of things work. Okay. But then the realist of my mind says it doesn't matter if you don't follow through, if you're not efficient, if you're not consistent and you're not accountable, because you won't get results. And so it's not just whether something works or not. It's how do we mitigate the likelihood you're going to fail, and how do we maximize the likelihood you're actually going to fall through? Let's go back to the working out example again. Do gyms work? Well, yeah, joining a gym helps. Do you need to join a gym to do sit-ups or push-ups or run around the block? No. So why do people do it? Because if I go somewhere where other people are working out, I'm in a more conducive environment to be more likely to actually work out. Yes or no?